Hello and welcome to the Astute Investment Management Quarterly Market Update with me, Paul Kelly, joined by Dr. Scott Osborne, Chief Investments Officer from Astute. Scott, where should we start today? There's been such a lot happened over the last 3 months. Why don't we start with the obvious question, which is relating to the Gulf crisis and how sensitive has all this been on the portfolio?
Yeah, it feels like old news already, doesn't it? Which is strange, really. But yeah, there's a lot going on. So let's dive in. Obviously, the main thing that everybody knows about in the Middle East is all the oil and natural gas, which is trapped behind the sort of closure in the Gulf there, and that Strait of Hormuz. Everything that's gone on with the actual war in Iran does feel a little bit like in the past. I'll talk a little bit about ceasefire in a moment. But essentially, what for our purposes, for the markets, what we're really considering is particularly the effects on energy through oil and gas, and secondary to that also all the kind of other things that we didn't first initially realise were kind of tied up in production or supply chains within the Middle East, which we have talked about in our last quarterly commentary, but I think that will be increasingly important as well. And then obviously, where do we go from here? What's the current situation, and so on and so forth. So firstly, on the energy piece, the oil price particularly has spiked, and it's been at times above $110. Now, in the past, if we'd had this sort of crisis, it easily would have got to $200. So from a starting point, it's already clear that the shape of the world has changed in the sense that the US is now a net energy exporter, is not reliant at all on any of this energy, and thus the demand shock, the supply shock from the Middle East doesn't necessarily affect demand everywhere. It's much more Asia and the sort of eastern economies, and then it ripples through back to the West as prices adjust. But above $90, as I think I said on our sort of response video, is still a pretty painful place, and we've been above $100 oil for reasonable amounts of time now, in the sense that there is so-called demand destruction going on, which is actually people consuming less, stuff not getting done, and that's negative for growth. Now, for the most part, that's still been restricted to Asia and Asian economies, where they've actually taken proactive measures like limiting transport or turning things on and off, just to limit how much oil or energy they're consuming, and that clearly will have an impact on growth there. We've had less of that, as we'll all know, in our day-to-day lives in the West, apart from petrol prices, where if you have to pay for petrol, then you're just paying more. If you don't necessarily have to make that trip, then maybe you volunteered to not do it, and in a sense that's kind of demand destruction as well. But we haven't really felt the impact of that. Energy prices definitely will go up, principally because of gas and liquefied natural gas exports from Qatar particularly. But again, because of the timing of as we move into the spring and the summer, we won't really know the full impact of that until later on in the year, when we see how much natural gas storage is been able to build it back up. But even there, we kind of learned our lessons from the Ukraine invasion, and we've imported a lot of natural gas from the US. So that's the energy piece, and I don't really want to say any more about that, because it really does depend on how much longer the closure persists, assuming that it is kind of still closed, which is a question mark itself. And there's not really anything more to add on that. The longer it goes in, the worse it will be, as those sort of energy effects feed through to inflation. The other bit is all the other stuff. This has kind of been more interesting, but it's also much more uncertain. Anyone who's read the quarterly commentary will know things like 90% of Africa's sulfuric acid comes from the Middle East. Who knew that was important? But if you want to extract copper from copper oxide ores, then you need sulfuric acid as part of that industrial process. So now you're not really talking about sulfuric acid anymore. You're talking about copper exports from Africa, which is a reasonable contributor to global copper supply and things. So again, aluminium, one kind of close to my heart, being that I was involved in scientific research before I came into investments, is helium. Lots of supermagnets, and research is dependent on liquid helium for supercooling. It's like liquid nitrogen, but even colder. So all that stuff we're only just unpicking now, and that has this kind of non-linear effects, or what we say is like, we're just not sure how that is going to ripple through the economy. It might be a big deal, it might be absolutely nothing, and that's kind of the stuff we're wrestling with at the moment in terms of our views about the future. And then finally, I guess, as a kind of update of where we are, and this will make a fool of me as it would have done if we'd recorded a video at any point in the last 3 months. The ceasefire is holding. We have actually had some big super tankers able to exit, although obviously on the permission of Iran. The US hasn't stopped them because they kind of imposed their own blockade. So in the last few days, it does feel like maybe the bottleneck is starting to ease. And so that would be very positive. We've seen market reaction to that, particularly again, government bonds recovering is linked to these inflation fears, but it's still not very clear, and it's not very clear how it progresses from here, how fast things get back to normal. Definitely some of the damage in the Middle East is going to take 2 or 3 years to recover. Oil stocks around the world have to be built back up. So we are going to live for the medium term with higher oil prices, with higher energy prices, definitely into the end of this year and into next year for sure. And that itself is contingent on how fast things get back to normal with the shipping. So generally from when we started, we think it's probably developed worse than what we thought it would do. The markets haven't really been too concerned about that, but that's partly because of all this stuff I've said, that we're really still wrestling and grappling with what are the long-term effects of all this stuff. So yeah, that's kind of the update on where we are and what we're thinking. It is very much a scenario, as it's always been. It will depend on how long it lasts, how fast we get back to normal, and then really we have to pick through the rubble of that to really kind of figure out what the long-term effects are on growth and inflation and everything else, really. So I'm not sure there's actually that much guidance or insight in there. It's really just a recap of where we are. But it's impossible to give you an idea of how things will pan out because it is so uncertain. We just have to live with that and kind of adapt as things develop.
Okay, Scott, one of the areas you've concentrated on there is about inflation. And I think everybody is now experiencing the increase in the cost of living. How do you see inflation moving forward, and what do you think the consequence is going to be with future interest rate developments here in the UK?
I mean, inflation really is the primary concern. Everything I just talked about there, Iran, there's other things going on, but principally why it's rippled through markets, and particularly bond markets, is the concerns around inflation. And the path for inflation is basically what most of the debate is around in markets these days. How persistent will the price increase, the primary price increase in oil and gas and energy and so on and so forth, but then also what we call the second round effects, which is, okay, does that inflation, which we know is going to occur and is already occurring in prices in some areas, feed through to other areas? So do workers demand higher wages because their personal, the personal expenditure is increasing? Food and petrol is going up in price. So do I ask for higher wages from my boss? And then that, entrenches this inflationary spiral. And, we've actually had central bank meetings recently, the last month. So the Bank of England, it was their first meeting post the Iran sort of conflict. And they laid out these scenarios. It's actually a really nice piece of work where they kind of predicted these different possible paths for inflation based on, okay, if oil prices go up much higher and stay higher for longer, and then we have a high degree of these second order effects, i.e. a high degree of pass-through from energy into other areas, which is obviously a bigger problem for them and their inflation targeting. And then some other scenarios where, it wasn't as bad, or actually it was basically nothing happening. And that's kind of their job, is to grapple with that. And it's pretty much the same across most central banks, so the MPC is a good indication. But basically what they're saying is the longer that it goes on, the more we are worried about the path of inflation and these second round effects. And it's that bit that's really unclear. And again, as we wrote about in the quarterly commentary, this is definitely not like 2020, 2021, when labour markets were really tight and there was huge fiscal stimulus coming from governments, literally giving money away in the US. That in itself is very inflationary. That is not where we are today. The labour market is loosening, if anything, and fiscal constraints are very, very tight. You think about how the government scrabbled around for spending in the UK particularly. So those second round effects are very uncertain, and it's on the bank really to judge that. But if you just work on their scenarios, the middle scenario, for example, which was probably round about this time the conflict is resolved and things get back to normal on a reasonable basis, we will see inflation move closer towards sort of 4% before coming down again next year. And in that scenario, they said that over the sort of next 3 years, they wouldn't necessarily have to adjust rates. Now you can argue whether that means they put rates up and then take them down again in the future, or they just keep them the same for a few years. But that's kind of the base case for most people. If it's longer, then rates will have to go higher. And that's already, you consider where we entered this year, we were expecting a couple of cuts from the Bank of England. So those have been completely ruled out. And now really the argument is about whether we stay still or there's a couple of hikes followed by subsequent cuts. But in amongst all of that, like you said, the cost of living and worrying about inflation, we still think there's really good investments out there that can defend against that. And within all the noise, it's perhaps going missing, because one of the principal sort of casualties of that fears about inflation have been government bond prices. The government is having to pay more to borrow money, and that means that the price of those existing bonds have gone down. But you can still get a kind of 5% yield on a 10-year government bond, which is really good. Even if you consider inflation will average 3% for the next 10 years, which it shouldn't do if the bank's doing the job, you're getting a 2% real return there. So, you have return above inflation for next to no risk, government risk. So it's easy to get caught up in that kind of the panic and the sort of noise around inflation. But we actually think there's some really good, valuable investments out there that can help offset that risk, and that's where we've been making moves, and a lot of our attention has been essentially. So the inflation picture is uncertain. That will be the big question for the upcoming year, but that doesn't mean we don't have the tools and sort of options available to us to offset that risk if dependent on these different paths and how it materializes. We feel pretty good about what's out there in terms of offsetting those risks.
Bearing in mind what we've been talking about today, Scott, can you talk to me in a little bit more detail about portfolio positioning? How has the portfolio been performing, and maybe the tweaks that you've been making to the portfolio over the past couple of months?
Performance is an interesting one. Obviously, if you it's been very up and down, but if you'd said at the beginning of the year all this stuff was going to happen, where do you think the market would be? It probably wouldn't be here. Because markets have been very robust, particularly the equity market. They've kind of shrugged it off essentially, and part of that is because the underlying fundamentals haven't really deteriorated necessarily, particularly in the West. Company earnings have still been good, sentiment and so on and so forth is at least holding up, which is to say it wasn't amazing going into this year, but it hasn't deteriorated enough that anyone's worried about it, and so the kind of initial shock of the Iran conflict was kind of washed away. It's been slightly different in bond markets because, like I said, the fears around inflation have clearly pushed yields up, and when yields go up, prices go down. So bond markets have suffered a little bit. But again, as I just sort of said in the answer to that last question there, we just see that kind of as an opportunity really, because we think people are kind of missing the bigger picture, or at least the longer term view on how good the value is at the moment in those areas. So yeah, that's kind of it feels a little bit like markets are overly optimistic to us, but it's rational. It kind of is rational to take that view when it's so uncertain about how things develop. Essentially, you don't want to just like close up shop and take your money out of the markets on a small tail risk chance if actually things are okay. So that's kind of how we've progressed. Having said all that, the moves that we've been making so far this year have been generally to trim risk. Particularly in the kind of more cyclical areas of the portfolios where we're sensitive to global economic growth. So think smaller companies or mid-sized companies in smaller economies where they tend to do much better if growth is good and everything's kind of doing well, but will suffer more if growth deteriorates or we roll over, or in a worst case scenario we kind of get a recession. Because on balance we think the optimism of the market versus the potential of what could happen, which as I've said is very uncertain, it kind of makes sense to take profits in some of these areas, or at least reduce the risk, because that upside downside has shifted from kind of looking equal or at least fairly balanced to a little bit more actually the downside looks a bit worse than the potential upside. So that's really the only changes that we've been making. Like I said, we still really like bonds, particularly UK gilts here. We've got a lot of that in the portfolio, and we feel pretty good about it, but we're not necessarily adding. Whereas on the sort of riskier side in the equities, those more cyclical areas that could be exposed to the more negative outcomes, which we don't, it's not our base case, but on a sort of risk management perspective, given valuations and how well markets have done, kind of makes sense to take a little bit of risk off the table there, and kind of go a bit more neutral across the portfolio, which was our view into the end of last year. We kind of just extended that into a few extra areas within the portfolios now. So we don't, we still feel relatively well insulated from this. We think we've got good hedges. Clearly, a sort of stagflationary environment where growth deteriorates and inflation stays high is kind of worst case. But we don't think that could persist for very long, and it's more of a kind of taking the long view around what is good value right now at the moment in markets. And as I've kind of alluded to, we kind of see value in bonds and actually deteriorating value, although not necessarily negative, in some areas of equities, and that's really at the margins, which is why most of the changes we've made are pretty small tweaks. So yeah, markets have held up better than what we thought, and as a result, we've not actually done that much, just a bit of sort of trimming and risk hedging around the edges.
Okay, Scott, very useful as ever. So for further information, please contact your normal financial planner. If you're new to Astute, catch out the link below and watch out for further updates on our YouTube channel. Thank you.